The rally in oil prices continues regardless of multiple measures proposed to tame the price pressures globally, and the surge in energy prices is already feeding into inflation expectations around the world. If you add the risk of the US tariffs returning to the picture, well, the outlook for inflation remains pretty much unsatisfactory right now. So, inflation is again the most important metric to watch to understand how the central banks will behave in the months ahead. And today's US PCE data will likely trigger an asymmetric market reaction as the data is backward looking and the next month's reads will be complicated. So welcome to Swissquote's daily market talk. It's Friday, 13th of March. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So we are coming toward the end of the second trading week since the US-Israel's joint attack on Iran caused major damages to both sides' oil facilities and to the trade through the Strait of Hormuz, where 20% of global oil flows and a lot of other goods are transiting. Oil prices have been wavering up and down on news since then, and several measures have been proposed to ease the oil rally. The IEA countries, for example, said they would release a record amount of oil from their strategic reserves. The US said that they will escort ships and they will insure them through the Strait of Hormuz. They temporarily scrapped a century-old maritime law requiring American-built ships to transport goods between the US ports, allowing other ships to do so. And more surprisingly, the US announced earlier this week, remember, that the Indians can now buy the Russian oil to tame the pressure in oil prices globally. And yesterday, the US came up and announced that, well, other people can also buy the Russian oil to tame pressures. But in weighing the strikes in the Middle East, the damage to the region's oil and gas facilities, and the closure of the Strait of Hormuz, with Iran decided to keep it closed and even lay mines to make sure that no one can pass in the future as well, reportedly, what keeps the upside pressure in oil quite tight. US crude rose to $98 per barrel level before easing this morning, while Brent crude hit the $100 per barrel mark yesterday and is consolidating near the $98 per barrel level this morning again. So it's pretty much clear that quick measures will not help relieve the price pressure in oil in the longer run. If the bombings in the Middle East continue to damage the oil infrastructure and disturb global trade, it will only get worse. Now, rising oil prices have been fueling global inflation expectations since the beginning of this month. In the US, the gasoline prices, for example, are up by more than 25% since the beginning of this month and by almost 80% since the beginning of this year. And I'm afraid the only way to pressure Mr. Trump and his administration will be these rising oil and energy prices in the US and spiking US consumer prices. Now note that oil price is only one part of the equation. The other is tariffs. The US trade officials are looking for ways to restore the tariffs that the Supreme Court judged unlawful earlier this year. This is the latest news on the wire regarding the tariffs, and the letter could add an additional pressure for US consumer prices too, because if companies deal with higher energy costs, for example, while they may be forced to reflect higher tariffs onto consumer prices. So the inflation outlook for the US and the rest of the world is not looking good. But unfortunately, the US will be decisive for all of us, and the midterm elections may be the only way to stop the mess, I'm afraid, and that's not before November. So what's next? Well, investors will get used to the war headlines faster than they will get used to the rising energy prices. So it will all be about rising energy prices. For now, they look threatening, and the US 2-year yield that captures the Fed expectations spikes past the 3.75% level as the rising energy prices are eating into the hope of Federal Reserve cuts this year. Activity on Fed funds futures stop pricing in a full 25 basis point cut this year. Yes, the Fed is no more expected to cut its interest rates this year, while the US President Donald Trump is asking for immediate rate cuts to, well, help relieve the economy. But the financial markets don't work that way. An unjustified rate cut will not help bring the yields lower. So as I was saying, the short end of the US yield curve is pushed higher these days by the idea that the Federal Reserve won't be able to cut the interest rates this year, and the long end is under another pressure, the growing fear that this war if prolonged, will add extra pressure on US debt, right? Because the US will have to finance a prolonged war. So the US 10-year yield is preparing to test the 4.30% level to the upside, while the 30-year yield topped the 4.90% level. So it is not really good for risk assets. Equities are feeling the pinch of rising yields and growing stress in the private equity space as well. More cockroaches, as Jamie Dimon calls them, come to the headlines every day. Banks are being shattered due to their exposure to private credit companies that see record demand for their redemptions, mainly due to their high exposure to heavily hit software company shares, and lack of appetite there in the software space continues as well. Adobe, for example, released earnings after the bell yesterday. Their results topped estimates on both revenue and earnings, but in vain. The stock slid 6 to 7% in the after hours trading on AI stress that was stopped by the announcement that their longtime CEO will be stepping down. On the other side of this AI trade, the big tech companies slid as well yesterday, shrugging off the post-Oracle earnings optimism. So overall, the S&P 500 fell 1.52% in yesterday's trading session, but the index has retreated by less than 5% so far compared to the January peak, meaning that the mix of all the bad news on the wire, the Iran war, the rising energy prices, the rising inflation expectations, waning Fed cut expectations, growing AI anxiety, and private credit stress. All of these news are not looking good, and I would expect them to lead to a deeper downside move on the index level. Now, US and European futures are pointing at mega gains this morning. I don't know why, but the bearish outlook will not reverse until the Middle East tensions materially ease or energy prices somehow come down sustainably. And that's not on the menu, unfortunately. So today, investors will watch the latest US GDP and core PCE updates. The core PCE being the Fed's favorite gauge of inflation. The US growth is expected to have slowed from 4.4 to 1.4% in the fourth quarter of last year as consumer spending cooled, high borrowing costs from the Fed weigh on demand, inventories normalize, AI investment momentum wane, and tariffs added pressure to trade and business activity. Core PCE, on the other hand, is expected to have risen to 3.1% from 3% previously, well sticky and well above the Fed's 2% official monetary policy target. And that 3% read would be before the war in the Middle East pushed oil and gas prices higher. So the reaction to today's data is expected to be asymmetric. No matter the slowdown in growth, inflation matters more right now. A strong PCE print today from the US will only destroy whatever is left from the Federal Reserve rate cut hopes for this year, while a softer than expected figure will be, better than a stronger than expected figure, but will hardly pour cold water on worries that inflation will be peaking in the coming months and that the Fed will not be able to cut the interest rates as much as it thought it would this year. So looking ahead, uncertainty, market volatility, and potentially slower global growth and rising inflation are on the menu. We know that markets will find a way, a floor to rebound, but we could see further sell-off before that moment arrives. So this is all for this hectic week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a safe weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.